what your true cost by department or budget is, because you could be talking, oftentimes when we're talking tax recovery, we're talking potentially millions of dollars, right? And that affects budgets significantly. You might be budgeting for that tax and it's not due, or you might not be budgeting for that tax and it is due, which is the more harmful scenario.
Growing a business requires a holistic approach that extends beyond sales and marketing. This approach needs alignment among people, processes, and technologies. So if you're a business owner, operations, or finance leader looking to learn growth strategies from your peers and competitors, you're tuned into the right podcast. Welcome to the WBS Podcast, where scalable growth using business systems is our number one priority. Now, here is your host, Sam Gupta.
Hey everyone, welcome back to another episode of the WBS Podcast. I'm Sam Gupta, your host and principal consultant at digital transformation consulting firm Elevate IQ. While several tax packages out there, such as Avalara and Vertex, can automatically monitor each state's tax rates and apply to each of your transactions, these packages rely on your data and accounting to determine your tax obligations. If you're not accounting for your product costs appropriately, you might be leaving millions of dollars on the table. You could save this money through tax recovery if you conducted a refund review. In today's episode, we have our guest, Jason Parr, who discusses the nuances of tax recovery of your purchases and why periodic refund review is crucial. He also touches on tax laws of different states and where you might have the opportunity to recover some of the taxes that you may be overpaying. Finally, he compares the sales and purchases side of tax obligations and any opportunities available through strategic planning of your facilities and warehouses. Let me introduce Jason to you. Jason Parr is the CEO of Pisner Johnson, a state and local tax consulting firm that has been around since 1992. Jason has a fascinating story. He started off as the staff assistant and worked up the ladder to become CEO within 25 years. Jason Parr has been employed at Pisner Johnson for much of his professional career. With that, let's get to the conversation. Hey Jason, welcome to the show.
Thanks, Sam. Great to be with you.
Of course, and I am super excited to have you as well, just because the kind of background you have in Texas. It's always fun to learn about the nuances and the implications. Just to kick things off, do you want to start with your personal story, Jason, and your current focus these days?
I will be happy to, yeah. So I'm currently the president and CEO of Pisner Johnson. And Pisner Johnson is a state and local tax firm. We also call ourselves the sales tax people. And our primary goal is to help people gain peace of mind when it comes to sales and use tax.
Yeah.
I have been with the firm for 25 years. I've grown up with state and local tax. We have a primary focus in sales tax, and our company began back in 1992 and has continued to serve manufacturers and other industries as it relates to tax recovery. All right, so when you talk about state and local tax, specifically sales and use tax, there's the potential that companies out there, as they grow, as they develop, as they acquire other companies and expand into other states, into other facilities, et cetera, there's a process of spending money to develop that, and the money is spent on expenses and fixed assets to help run the business. And there's 50 states, and so obviously there's 50 different sales and use tax laws across those states. And those states provide opportunities for companies to be able to be exempt from sales and use tax, either based on the type of company they are or
Yeah.
how they use the purchases in line with their business.
Okay, very interesting. So obviously this gets very exciting, especially when we talk about the nuances in terms of where we might be able to save money. So I think there are going to be some very interesting stories there, right? Before we do that, we have one of the standard questions that we ask every single guest, and that is going to be your perspective on business growth, Jason.
Yes, there's top line revenues, right? Every business is pursuing top line revenues, what they're trying to accomplish, and sometimes they're not aware of the aspect of what I call the bleeding,
Yeah.
where dollars are potentially being lost in the process of their business. And so one of the things we say at Pizer Johnson is we over me. One of the passions or the joys that I have in state and local tax and my time with Pizer Johnson
Yeah.
is we're not your typical accounting firm that may be coming in with some bad news. Typically, we're there to help people. And in the process of helping people, we've even saved some businesses in that process.
Okay, very interesting perspective. So let's dig deeper into this. So you mentioned a couple of different things, and I guess, each of them could be a very deep topic. But if we look at the overall geo of the US, and you did mention that there are going to be 50 different laws just because there are 50 different states. So let's say if I am trying to incorporate a manufacturing organization and I have freedom to incorporate wherever I want, and let's say if I'm simply trying to set this up, so which are going to be the states where you are going to have the lowest sales tax? But obviously, I don't think you can simply look at the sales tax and incorporate, because you need to look at where your customers are, where you are selling, right? So what would be your advice, let's say if somebody is incorporating the let's say either the manufacturing facility or the retail facility, what is going to be your advice in terms of which states are the right fit if we are simply trying to gain from the sales tax perspective?
That's a great question, Sam. From a manufacturing standpoint, sales tax has two things. I'll just share real quickly when it comes to Nexus. Nexus
Yeah.
used to be based on where your operations were. Now it's
Yeah.
based on where your customers are, right? That's from a
Yeah.
collection of sales tax. And that's a topic we could certainly cover in great depth. And
Yeah.
it's one that people need to be aware of because they may have more responsibility in more states than they may be aware of. And so we want to talk to everybody when it
Yeah.
comes to that. But when it comes to your purchasing,
Yeah.
as it relates to running your business, the purchase of expense items and fixed assets to run your business, that's
Yeah.
all based on where you are, right? So
Right.
when you start thinking about a manufacturing facility and you're thinking about what are the tax consequences of running a business in a particular state, you start looking around at states that, and states do this, they pass tax exemptions in the sales tax code to drive industries to come to their state and open up manufacturing facilities. And we can talk about several states, but obviously a lot of times people think of Texas and they think, well, Texas is a tough state for businesses from a tax perspective, but we're getting an influx of businesses because Texas is very friendly. Texas has a franchise tax, but it doesn't have an income tax. And when it comes to sales and use tax exemptions specifically for manufacturers, there are some nuances that I think are valuable. Number one, in other states, there are manufacturing exemptions, but you either have to be registered as a manufacturing company by your NAICS code, or there are certain aspects of production that may be exempt and other aspects are taxable, and there might be some complications to it. One of the great things about Texas, if you're a manufacturer, is not only is there a manufacturing exemption on items that you purchase that are used within your business to produce items, but that law applies to processes within businesses. So you don't have to be registered as a manufacturer. Just to give you an example, you could be a retail store that is providing materials that are cut for you in that store. And you might not think that those items that you use to cut those materials would be exempt from tax, but they are, because you're actually using them to process tangible property for sale. And that's what the exemption allows you in Texas. Just to give you an example, we were able to obtain a refund for the pieces of equipment that are behind the store that take all of the cardboard from all of your inventory that you're bringing into the store. And you have to have a way to crush that and bind it. They're called balers.
Yeah.
You crush them, you bind them, and then you sell those items to recyclers. Because you process that into tangible property that you hold for sale to other people, you can actually buy those items tax-free. Now, from a full-scale manufacturing standpoint in the state of Texas, equipment that you purchase, ingredient components, items that go into your product, repair items on that equipment, repair parts, and even repair services, which are typically taxable in the state of Texas, are not taxable on that type of equipment. So manufacturers and processors have really significant exemption opportunities in the state of Texas.
Okay, very interesting perspective there. So I don't know if I follow it completely. So I am actually going to provide some examples from my side. So let's say if I am trying to set up a manufacturing facility, and obviously there are going to be two sides of the taxes that you mentioned. One is going to be the goods that you are buying. So you are paying the taxes to the vendor when you are buying, there is going to be some sales tax component there. And then when you are selling, then there's going to be a sales tax component there. So when I look at the exemption from both ends, it's going to be if I'm buying, then sometimes I don't have to pay just because of the reasons that you mentioned from the purchase side perspective. And the same thing could apply from the sales side perspective as well, if they are going to be the exempt item. And obviously the tax recovery is going to be, if something is going to be exempt, then that we can analyze that, okay, these are the items and categories that are going to be exempt. So now you are looking at that and saying, okay, when you process the transaction, was it processed in the right manner or not? And if there could be any opportunities for the cost saving. So again, going back to my example about setting up the manufacturing facility, let's say if I'm setting up the manufacturing facility, am I simply looking at where I am going to get the cheapest goods? Should that be a variable? Or should I be thinking more in terms of if I am serving, let's say, state of Texas, and on my 50% of the customers are in the state of Texas, and then let's say 20% are in Kansas, and then 30% are in Oklahoma. So should I be looking at that? If I have let's say the facility as well as the customer in the same state, do I gain anything, or that does not matter at all?
Yeah, on the sales side, it doesn't matter too much because the way it works in sales tax law now, if you have a responsibility to collect tax, then it's easy enough to register and collect that tax, and you collect tax unless they give you some sort of certification that they're exempt from the tax, right? So once that's the situation, then the sales side, there's not much value in looking at the sales side as it relates to where you might locate a manufacturing facility, but huge factor in the state's willingness to give you some exemptions and even give you some investment credits to come into the state. But from a purchase standpoint, it's really important to recognize states that exempt equipment, materials, parts, services related to your production facility, because you have huge cost savings when you come into that type of situation. One of the other things Texas allows you to do, for instance, now this is really nuanced, but let's say you have a production facility that you're building in Texas, and it's outside of the city, but in county land. One of the things Texas allows you to do is impose your own tax on your purchases. It's called a direct pay permit. And there are other states that provide this process to obtain a direct pay permit. What the direct pay permit does is it allows you to say to all of your vendors, don't charge me any tax. I'm responsible for my own tax. And in the state of Texas, in the city, you might have a tax rate of 8.25%, but in the county, it might be 6.25%. So not only can you gain a full exemption from tax on certain equipment, parts, supplies, materials, and services, but because you're applying your own tax, you also apply that tax at the lower rate based on where you're located in the state. So It's really important from a sales tax standpoint to strategically consider where should your production facility be,
Yeah.
and because of the exemptions that are allowed by the state and
Yeah.
other provisions in the tax law that might have cost savings associated.
Okay, so that's very interesting. So now what I'm going to do is, obviously, as you mentioned, that if you look at purely from the sales tax perspective, where your customers are, it does not really matter. But let's say if I'm the manufacturer and I am distributing my own goods as well, so then I am going to have some sort of distribution center. Maybe I have the e-commerce front where I am supplying or distributing from a specific state. So I don't know if I should be thinking about where my warehouse needs to be, but then there might be some more further complications. Let's say if I may have retail outlet. If I have the retail outlet, obviously I am selling in that specific county and state. So let's say if you were approaching the warehouse planning and the retail storefront planning, how would you approach this? What are the factors that you are going to be looking at from the sales tax perspective? Which are the states that are going to be slightly more favorable? Let's say if I have two states that I can go to, both of them probably have the similar customer base, but from the tax perspective, one is going to be more attractive than the other. So again, looking at the geo, which are going to be more attractive to open either the distribution center or the retail outlets?
Well, there's 5 states that do not impose a sales tax law, and the way to remember those is the term nomad, right? So New Hampshire, Oregon, Montana, Alaska, and Delaware.
Okay.
So in those states, you're not going to pay tax on any of your equipment, materials, supplies. You're not going to pay tax on anything. You're also not going to be responsible to collect tax on a retail center outlet. You're not going to be responsible for collecting tax on any e-commerce sales into those states, right? So if it doesn't make good sense to necessarily go into those states to set up your production facility, then you're going to be looking at states that have good exemptions on sales tax. They have good provisions or investment credits that invite you into their state. They might have a lower tax rate or bracket in addition to those types of exemptions, et cetera. But then when you're looking from an e-commerce or a retail situation, it really comes down to this. So we call this the biggest tragedy in sales tax. And that is, if you had a responsibility to collect the tax at the time of the sale and you didn't, then the state could potentially come back and pull that tax out of your own pocket with penalty and interest, right? Complete margin killer if you should have collected it and didn't. So when it comes to the sales side, it really comes down to not where you're located anymore. Let me just say this. On the purchase side, it's all about where you're located.
Right.
On the sales side, it's all about where your customers are located. And in today's environment, you can't really control where your customers are located. So when it comes to the sales side, you really need to answer 3 important questions. Number 1, do I have nexus in that state? Number 2, is what I sell taxable in that state? And then number 3, how do I sell that item? Do I sell it on a marketplace or on my own website? Answering those 3 questions will determine whether you have a tax responsibility on the sales side in any particular state. We provide a free consultation that's called a What's Next call to answer those questions. So we would invite anybody to go to pj.tax, have a What's Next call, which is a free consultation to help you gain peace of mind and confidence on what to do next on the sales side. So sales side's all about where customers are located. Purchase side is all about where you're located. And so I think if you're trying to strategically determine where am I going to put a production facility for a manufacturing operation, then I'm looking at one of the 5 states that doesn't tax it, doesn't have a sales tax, or I'm looking for states that may have a sales tax but don't have an income tax, so that I'm not responsible for income tax on my operations in that state. And then lastly, I'm looking for the one that has the most beneficial exemptions for the type of production facility that I'm building. And there's probably maybe a dozen states that have exemptions, and then there's a few states that have very good exemptions as it relates to production. Missouri is one of them. Iowa is one of them. Texas is one of them. Washington has a pretty strong taxing situation, but they do have good exemptions when it comes to manufacturing. New York and New Jersey have some good exemptions when it comes to production, but the states are onerous when it comes to income tax and other tax responsibilities. So it really comes down to those few states that provide the best exemptions, but also provide the best business environment as it relates to other taxes that might be imposed on the business.
Okay, so one of the comments that you made related to type of production. So obviously each production is going to have its own nuances, the kind of equipment they are going to use, the kind of materials they are going to use. So are there specific industry that are going to be favorable in any specific state?
Yeah, manufacturing for sure. It is one of the most loved industries to bring into a state. And so states provide some pretty significant exemptions for manufacturers. The nuance that I was explaining earlier is in some states, you have to qualify for that exemption by the nature of your setup and your NAICS code and what you do as a production facility. Some states also require you to pay the tax and get it back as a rebate or a refund after you've paid the tax. The really great states, and I mentioned Texas specifically just because of the way I call their manufacturing statute reads. Yeah. It's not just imposed on manufacturers. It's imposed on processes, specifically any equipment or materials used to process tangible property for sale to another party. And so you begin to be able to utilize these exemptions in ways that you may not have considered because you're not, quote unquote, a manufacturer, right? A retail operation that has certain pieces of equipment or property that are used to do this, but you wouldn't necessarily think of as processing or manufacturing components.
Yeah. So very interesting. So when we look at these NAICS code and we can structure it the way, we really want, to be honest, and I don't know what guidelines are there, because let's say if I'm the contract manufacturer and I may be serving many different industries, if you look at purely from the NAICS perspective, I am probably not going to have 5 entities. So for example, let's say if I'm the contract manufacturer, I'm developing parts, I may be serving automotive, I may be serving aerospace, I may be supplying to oil and gas. So are there any specific guidelines in terms of which NAICS code I should be filing under? Are there any advantages? Let's say if I position myself as more of the aerospace, but I end up selling more into the oil and gas.
Gotcha. Yeah. I think in the end, the way the NAICS code comes down to it, certain states just require you to have a particular code to be able to claim exemption on certain types of purchases, right? And it's not necessarily the type of industry that you're in. But I will say, as you're indicating, there are states that it's not just manufacturing or certain processing or certain codes, but they also provide exemption for certain types of industry, right? Like aerospace industry, et cetera. You're also going to find states that their tax law provides good exemptions. One that's just kind of wacky out there is Indiana for restaurants, right? You think about a restaurant. So for instance, in Texas, restaurants are able to gain exemption on certain pieces of equipment, right? Because an oven converts food ingredients into a product that you hold for sale, and it's taxable in the state of Texas. So restaurants can gain some exemption, but they don't get exemptions for tablecloths and other things that don't process a product for sale. But in Indiana, just very specific to restaurants, they give you exemptions for your tablecloths and plateware and all of your utensils and pots and pans and on and on and on. So every state has a certain tax law
Yeah.
and taxability code, and then they provide certain exemptions to certain types of industries. And it's a full myriad of different tax laws and different exemptions utilized to invite certain industries or companies to come into their state.
Very interesting. So now I am actually going to discuss one more scenario, and I know that, tax recovery, there are going to be many different scenarios. So one of the things that we typically notice in our customer base, and you have experienced this as well as we were discussing during our pre-show, that let's say if I want to track the sales taxes, one of the easiest way is going to be if I go for either Vertex or Avatex, and then they are going to be tracking the sales tax for me. But that does not complete the story, because in my experience, one of the things that I typically notice in my space is if you have all of your books captured accurately, the cost that you have, if they are allocated properly towards your product cost, then you would know the exemption. I mean, your Evertex or Vertex is not going to know whether you are allocating those costs correctly or not. So when you do these tax recovery exercises, do you come across these situations as well, where some of this cost need to be allocated towards the product cost, because that is probably going to be exempt from the taxes, and the manufacturers or the distributors that we work with, I mean, they don't necessarily have this costing background. Sometimes they are simply going to average it out. They are going to put it in SG&A. They don't really understand what are going to be their tax implications, right? So do you have any specific stories or scenarios that you might be able to describe where tax recovery is really beneficial?
Oh, that's interesting. I like your perspective and your approach there from an accounting perspective and from a cost accounting perspective in managing that. You see this probably the where we see it the most is in contractors. So in the construction industry, you've got some unique states that tax construction activities differently. Most of the time when you're a contractor performing construction activities, the state deems you the consumer of the materials and the costs that are being incorporated into real property. But there are states, and again, Texas is one of them, New York, New Jersey, Connecticut, some others, that actually tax certain construction activities performed by contractors where they become a reseller of the items that they incorporate. And so from an accounting or cost segregation perspective, we do see it a lot in contracting, because you need to know whether you're responsible for the tax or not, because when you are going to do a bid, if you cannot charge tax on the services or activities that you're performing, then you do need to make sure that the tax that's paid on those items is incorporated into the cost associated with performing that contract. And I would imagine in a manufacturing or other type of production situation, recognizing research and development activities and certain materials and equipment are exempt in certain states. From a cost perspective, from an internal accounting responsibility, I imagine it would be valuable or important to know what your true cost by department or budget is, because you could be talking, oftentimes when we're talking tax recovery, we're talking potentially millions of dollars, right? And that affects budgets significantly. You might be budgeting for that tax and it's not due, or you might not be budgeting for that tax and it is due, which is the more harmful scenario, I would think. So, I would imagine that would play a significant role in budgets, and oftentimes the process of performing what we call a refund review with tax recovery, our recommendation is that you do that at least every couple of years. But if you haven't had one performed in the last 3 or 4 years, then for us, urgency is the issue, because states have statute of limitations on how far back you can go and obtain a refund that was overpaid on a purchase. And most of those are somewhere between 3 to 5 years. And so you do want this to be a part of your regular course of responsibility, whether you're able to do it yourself or you bring a group in to conduct a review and see if there's potential overpayments that are occurring. In that process, you typically establish some strategies to avoid continued overpayments, right?
Yeah.
The last thing you want is for a company to come in, find overpayments, and then they leave, and then they come back and they find the same overpayments or more overpayments, right?
Yeah.
The idea is to work with a group that's going to help you organize the strategies that keep you from underpaying and overpaying.
Yeah.
The state comes in and audits you for underpayments. They don't typically look for overpayments. We come in and look for overpayments to try to obtain refunds on behalf of our clients, but we also work with our clients and make them aware of potential underpayments and also provide the proper certificates or certification to vendors to stop the overcharging of tax going forward. And so it can be significant. So there could potentially be money on the table that you're not aware of. And the only way to identify it is to conduct a refund review and understand if there's potential refunds that need to be obtained.
Yeah, so that's very interesting. And as you pointed out, I mean, nobody really is going to mind overpayment. I mean, I would not mind if my clients are going to overpay me. That never
Right, the
happens.
states. Yeah, exactly.
Everybody likes free revenue. Okay, so now if I go back to my state example, how are they finding what a company is really obligated for? Because as you know, one thing you don't want to do is you don't want to talk to tax agencies if there is going to be any sort of penalty, because the bills could be really high. In some cases, like even if you are due, let's say $100, but these penalty and interest, they could be thousands and thousands of dollars. So what is their process in finding out the total amount due from your perspective? So let's say if the way I'm doing accounting, I am not being audited by PwC or EY. I'm not even being audited by any smaller accountants. The only thing I'm doing is I figured out my chart of accounts. Maybe my accountant did 15 years back. I'm simply doing the accounting based on that. Maybe my business model changed completely. There are some gaps in the total allocation, and because of that, I'm probably going to be obligated of a lot more than what I am paying right now, just because the way I am doing my accounting. Okay, so is there a way these you can find out that you should be paying for more?
Yes, absolutely. We call them nexus studies or risk assessments. Some states also allow you to do what's called a managed audit. They allow you to manage your own audit to review your books. When we do a refund review, we're looking at overpayments and underpayments. So obviously, the overpayments are the benefit. It's money that's already been paid. It's money lost if you don't claim it back. And so we're pursuing those refunds. But in the course of looking for overpayments, we look at the whole operation. And if we see areas of underpayment, meaning, maybe you are following a diagram from 10 years ago or 15 years ago that says you don't owe tax on these items, but the tax law has changed. Tax law changes constantly. And so where something may have been exempt in the past, it might be taxable now. And if you're not paying tax on that when you're purchasing it, for sure, when the state comes in, they will identify that and require it out of your own pocket. And so for us, we say that you should have a review done every couple of years and update your processes to ensure that you don't have underpayments or overpayments. In the end, accountants, especially CFOs, they don't want big overpayments or big underpayments. They want it to be, they don't want any large fluctuations. And so really to avoid that, and just like you said, if you've got an automated system up front, that's focused on what you should be charging on what you sell, not on what you purchase. There's very few really good, if any, what we call use tax systems that can automate the tax you're paying on the purchasing side. And so it's really important every couple of years, at minimum, you're looking at your purchasing patterns and trying to understand whether you should be paying more tax or getting tax back, to the point where you have a good process of law review on a periodic basis and good processes that are helping you capture the tax that should be paid and make sure that you're not paying tax out that doesn't need to be paid, because you don't want to be, I call it bleeding. You don't want to be bleeding dollars if you just knew that you shouldn't be paying tax on those types of transactions.
Okay, so do you have any specific stories that you might be able to share related to tax recovery? Let's say if you worked on a specific engagement in last 3-5 years and you found any shocking revelation in those engagements related to tax recovery.
So I'll give you two thoughts here. One
Okay.
is when it's when you do a tax refund review, there's no cost to you unless we find refunds, right? And you would imagine in your mind that because there's no cost unless you find refunds, that everyone would say, "Oh, please come in and look." But more times than not, people will say, "No, we've got that taken care of," or "We don't have the time for it."
Yeah.
I will tell you, 95% of the time that we conduct a refund review, and almost always after someone says, "No, we don't pay tax on anything," we find refunds. So number one, it's important to go ahead and have a refund review. It doesn't have to be us that does it, but you should have somebody reviewing your purchases. So sometimes the tax law is interpreted differently. So I'll just give you an example in Iowa. In Iowa, this is subject to change, but over the last decade, processors in Iowa can purchase equipment, repair parts, other materials used in the production of tangible property for sale tax-free. They can purchase it exempt. But specifically, those who process food ingredients have a special provision that's not well known that allows for food processors to have not only all of those same exemptions applied to their operations, but taxable services associated with their operations are exempt as well. And I'll just give you some detailed examples, right? So all of the equipment, the parts and materials, everybody understands. Taxable services are a little bit more unique. So for instance, pest control services to control the food environment are taxable in Iowa, exempt to those who produce food ingredients. Climate controlled conditions to keep the product at a level that it can be sold to the public, typically taxable in the state of Iowa, exempt for food ingredient processors. Something that you may never think of, security services, right? The security services, the security guard outside of the facility, that's a taxable service in Iowa. But for producers of food ingredients, you can exempt those processes. So there's several taxable services that would typically be taxable in any situation except when you're producing food. And so we worked with a food ingredient producer in Iowa a few years back, and where you imagine you might find some refunds, the refunds ended up being in the millions of dollars because of the unknown application of a part of the law that the accounting group just didn't know about.
Yeah, that's amazing, Jason. So that's it for today. Do you have any last minute closing thoughts or advice for our listeners?
Yes. At Pizer Johnson, we use the term collaboration builds confidence. I really believe that nobody truly wants to go it alone. A lot of times we're in a situation where we want to kind of prove ourselves, or we want to prove to others that we can do whatever we've been asked to do. But what we find is most people have greater confidence and greater peace of mind, two things that are important to us for our clients and for our employees, when they collaborate and when they get a confirming nod from those that they work closely with. And so I would just share with everyone, collaboration is key to making the best decisions as you move forward.
Okay, and my personal takeaway from the conversation is going to be, even though tax is going to be very complex and sometimes frightening as well, but just because it is complex, there are also opportunities there. So it's up to you how you want to capitalize on those, and you can probably save millions of dollars if you knew how to maneuver around the taxation. On that note, Jason, I really want to thank you for your time. This has been a powerful conversation.
Thank you, Sam. It's been a pleasure.
I cannot thank our guests enough for coming on the show, for sharing their knowledge and journey. I always pick up learnings from our guests, and hopefully you learned something new today. If you want to learn more about Jason, head over to PeisnerJohnson.com. It's PeisnerJohnson.com. Links and more information will also be available in the show notes. If anything in this podcast resonated with you and your business, you might want to check other related episodes, including the interview with Scott Berman from River North Financial Group and Jake Lindmark at Optimally, who discusses how big data solutions have evolved and now accessible for small to medium-sized businesses. Also, the interview with Alok Ajmera, who discusses the corporate performance management function and breaks down its processes into the tactical cost-saving and strategic components. Also, don't forget to subscribe and spread the word among folks with similar backgrounds. If you have any questions or comments about the show, please review and rate us on your favorite podcasting platform or DM me on any social channels. I'll try my best to respond personally and make sure you get help. Thank you, and I hope to catch you on the next episode of the WBS Podcast.
Thank you for listening to another episode of the WBS Podcast. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. For more information on growth strategies for SMBs using ERP and digital transformation, check out our community at WBS.rocks. We'll see you next time.